In the early 2000s, the American housing market looked solid and safe. Families wanted homes, banks wanted business, and house prices kept rising. To many people, it seemed like a simple rule had become true. Home values would only go up. Behind the calm surface, a dangerous chain was forming. Banks began giving mortgages to people with weak credit histories. These loans were called subprime mortgages. Some lenders no longer focused on whether borrowers could truly afford the monthly payments. Instead, they focused on how many loans they could spread quickly. A key reason the problem grew was that loans were not kept in one place. Banks bundled many mortgages together and sold them as financial products to investors around the world. These products looked safe because they were often given high ratings. To many buyers, they seemed as reliable as ordinary savings. But the risk was hidden inside the bundle. At the same time, the housing boom fed itself. Rising prices made borrowing easier, and easy borrowing pushed prices even higher. More people bought homes they could barely afford. Builders kept building. Investors kept buying. The whole system seemed to move forward on confidence. Then house prices stopped climbing. When prices flattened and began to fall, the weakness inside the system became visible. Borrowers with adjustable rate mortgages saw their payments rise. Many can no longer pay. Foreclosure spread. As more homes were forced onto the market, prices fell even faster. The same homes that had been treated like guaranteed wealth suddenly lost value. The bundled mortgage products began to collapse in value too. Since banks and investors around the world had bought them, the losses were not limited to one neighborhood or one country. They spread through the financial system like a shockwave. No one was sure which institution was holding the worst losses, and that uncertainty made everyone nervous. By 2008, fear had reached the biggest banks.